Imagine this. One morning, breaking news flashes across every television screen. Tensions in the Middle East are rising again. Military bases are on high alert. Warships are moving. Missiles could be launched at any moment. The world holds its breath, because history has taught us one simple rule. Whenever the Middle East catches fire, oil prices explode. It happened in 1973. It happened during the Gulf War. It happened after attacks on major oil facilities. Every single time, fear pushed oil prices higher. But this time, something unbelievable happened. Instead of rising, oil prices started falling. Investors weren't panicking. Markets weren't crashing. In fact, many traders were quietly celebrating. How can oil become cheaper when one of the world's most dangerous regions is once again under pressure? Is the world ignoring the risk of war? Has oil suddenly become less important? Or is there a much bigger game being played behind closed doors? A game involving America, Iran, billions of barrels of oil, and trillions of dollars flowing through the global economy? Because sometimes, the biggest battles are not fought with missiles. They're fought with negotiations. And the outcome of those negotiations can change the price of everything. From the petrol in your car, to the food on your dining table. Today, we are going to uncover the real reason why oil prices are falling. Even while the Middle East remains one of the most dangerous places on earth. To understand today's mystery, we first need to understand one simple fact. The Middle East isn't just another region on the map. It's the heart of the global energy system. Countries like Saudi Arabia, Iran, Iraq, Kuwait, and the United Arab Emirates together produce a massive share of the world's oil. Every single day, millions of barrels leave this region, fueling factories, powering airplanes, running ships, and keeping the global economy alive. But here's where the story gets even more interesting. Most of that oil travels through one narrow waterway, the Strait of Hormuz. At its narrowest point, it's only a few dozen kilometers wide, yet nearly 1/5 of the world's oil passes through this tiny passage. Imagine if that route were blocked for even a few days. Oil supply across the world could be disrupted. Petrol prices could surge. Inflation could rise. Stock markets could panic. That's why every missile, every military exercise, every political statement from this region is watched by investors around the globe. Normally, even a small increase in tension pushes oil prices higher. But not this time. Something much bigger is changing the market. While television channels focus on missiles, professional investors are watching something completely different. Negotiations. Behind closed doors, the United States and Iran have once again opened channels of communication. And that changes everything. Iran isn't just another country. It holds some of the largest proven oil reserves on Earth. The problem is, for years, international sanctions have prevented Iran from freely selling much of its oil to the world. That means millions of barrels have remained largely outside the global market. Now imagine this. What if those sanctions were eased? What if negotiations actually succeeded? Suddenly, millions of additional barrels could return to global supply. And here's something fascinating about financial markets. They don't wait for agreements. They don't wait for official announcements. They move on expectations. The possibility of more oil tomorrow can reduce prices today. That's exactly what's happening. The market isn't reacting to today's supply. It's reacting to tomorrow's expectations. But diplomacy isn't the only reason oil prices are falling. There's another enemy. One that doesn't fire missiles. One that doesn't appear on television. And yet, it has the power to move global markets. That enemy is a slowing global economy. Over the last few years, the world's biggest economies have started losing momentum. China, the world's largest importer of crude oil, has seen weaker industrial growth. Factories are producing less. Construction projects are slowing down. And when factories slow, they burn less fuel. Europe is facing its own economic challenges. High inflation, weak manufacturing, lower consumer spending. All of this reduces energy demand. Even the United States, despite having one of the strongest economies, has seen businesses becoming more cautious. Companies are cutting costs, consumers are spending carefully, and investors are preparing for slower growth. Here's the simple truth. Oil prices don't depend only on supply. They also depend on demand. If the world needs less oil, prices naturally begin to fall, even if tensions remain high. That's exactly what the market is pricing in today. Here's something that surprises most people. Financial markets don't wait for events to happen. They try to predict the future. Imagine you're an investor. You believe Iran may soon export more oil. You also believe the global economy may slow further. What would you do? You'd probably sell oil today, before prices fall tomorrow. Now imagine millions of traders around the world thinking exactly the same way. That creates massive selling pressure, and prices begin falling, long before a single extra barrel reaches the market. This is why market psychology is so powerful. Sometimes, expectations become more important than reality itself. The oil market isn't reacting to today's headlines. It's reacting to tomorrow's possibilities. And that's what makes global finance so unpredictable. The domino effect. Markets are deeply linked. A banking crisis in Europe or a supply chain halt in Asia instantly ripples across the globe, creating a chain reaction. Human emotion and herd mentality. Fear and greed drive markets more than logic. When panic sets in, investors rush to sell all at once, leading to sudden crashes that no algorithm predicted. Black swan events, unforeseen shocks like global pandemics, sudden geopolitical conflicts, or regulatory crackdowns can change the economic landscape overnight. Algorithmic trading. Computers execute millions of trades in milliseconds. When something goes slightly wrong, these automated systems can trigger massive, rapid market swings. Decoding this chaotic market is impossible. Subscribe now for more powerful finance insights.